Welcome to Core Concept HQ, where big ideas are simplified. Today, we're breaking down the book, How to Make Money in Any Market.
This is a deep dive specifically for you, the listener, who is probably already comfortable with the basics. You know what the S&P 500 is. You've heard the advice.
Oh yeah, the dominant wisdom. You hear it everywhere. Buy
Right.
index funds, don't touch anything else, and just never look back.
Right. And to be clear, the book doesn't say that's bad advice. It actually agrees with the safety part, the diversification. That's your core.
You for buffer your foundation.
Exactly. But here's the radical idea, the challenge this entire deep dive is built around. Index funds will only ever make you average.
An average feels safe, but it doesn't really get you where you want to go, does it? It's not going to create that generational wealth or give you real confidence when the market gets shaky.
Nobody puts in 40 years of work just to be average. I mean, the whole point is financial freedom. So the mission here is to push back on that, to give you the confidence to go beyond average.
And the book lays out a plan for that, a two-part portfolio plan.
Part one, you keep that core holding. You keep the index funds for your stability and safety. But part two, well, that's where the magic happens.
That's the hero stocks.
That's the hero stocks. You dedicate a smaller, really strategic portion of your money to individual growth stocks. And you only need 5 of them, chosen with, some real discipline.
And the core idea here, which I think is just so empowering, is that the best ideas, the stocks that have created the most wealth this millennium, they weren't secrets.
Not at all. They weren't buried in some complex financial document only insiders could read. They were, and they still are, completely observable to anyone who bothers to look around.
It's a huge mental shift, right? From just passively accepting the average to actively observing your own life.
It is, and we can jump right into that with this fantastic story that really grounds the whole philosophy. The story of a guy named Mr. Hank.
Mr. Hank, the retired Marine Corps colonel. He ran a paper bags warehouse next to the author's dad's business.
That's the one. He was this huge, booming personality. But what he was doing quietly behind the scenes was so much more impressive than his, loud personality suggested. He was building a fortune.
And it was the author's father, Pop, who noticed it, the one who was kind of struggling with his own business.
Exactly. Pop would point him out and say, Mr. Hank is rich because of the stock market, and the how is the most important part. How did this paper bags colonel do it?
It wasn't some complex trading strategy.
Not even close. He just religiously, consistently bought shares of one company, Merck Sharp and Dome.
And the key thing is, if you looked up Merck in the paper, it was boring. It wasn't jumping up 4 points one day, down 5 the next.
No, it seemed to go up a little bit more than it went down, consistently.
Yeah.
Week after week, month after month, decade after decade. It was just calm persistence.
So when the author finally gets a peek at Mr. Hank's stock ledger...
Yeah, this little black leather book, the math was just staggering. Mr. Hank's shares in Merck were worth $3.6 million. And get this. That calculation didn't even include all the dividends he'd been reinvesting for decades.
So a guy running a paper bags warehouse, not a Wall Street genius, just calmly gets rich by owning a piece of a solid, durable pharmaceutical company.
That's the whole baseline for success in the book, and then you contrast that with Pop's investments.
Oh, Pop's speculative investments, the total opposite.
The complete opposite. Pop was always chasing the hot tip, the fast return. He gets a tip from some big shot and buys this company called National Video.
They made vacuum tubes for color TVs, right?
Exactly. And at first, it looked like a genius move. The stock was exciting. It soared from $40 a share all the way up to $140.
So he felt like he was on the fast track. He was probably crushing Mr. Hank's boring Merck stock.
For a minute, yeah. But the problem was the underlying technology just vanished. Transistors came along and replaced vacuum tubes overnight.
And the company went bankrupt.
Went to zero.
Yeah.
But Pop's savings went with it.
So there it is. That's the whole lesson in one comparison.
It is. Durable wealth comes from saving and consistently buying a piece of a superior, adaptable company like Merck. Financial ruin comes from chasing hype, from chasing a fleeting technology that just can't last. The whole deep dive is about finding those durable heroes.
Okay, so that story really sets the stage for the first big hurdle, which is mindset. You can't have persistence without conquering fear.
And the author has a name for the constant negativity we hear. He calls it the great lie of caution.
You see it everywhere. If you turn on the news or read a headline, it feels like it's always a terrible, dangerous, just awful time to invest.
Always. He says he can't remember a single time in 4 decades where the media consensus was, wow, you know what? This is a great time to buy stocks.
But history tells a completely different story.
A totally counterintuitive story. I mean, look at every major sell-off. The crash of '87, the dot-com bubble bursting, the Great Recession in '07, '09, even the COVID flash crash.
Every single one.
In hindsight, every single one was a legendary buying opportunity. It was basically a clearance sale for the best companies in the world.
The resilience is just... It's amazing when you zoom out. If you had put just $1 into the S&P 500 back in 1980, through all the wars, recessions, crashes, that $1 would be worth over $150 today.
Let's put that in real terms for people listening. If you invested $10,000 back then and just left it alone, reinvested the dividends, you'd have more than $1.5 million now.
It's just undeniable proof. The stock market isn't a casino. It's the most reliable creator of long-term wealth we've ever seen.
So why the fear? If the data is so clear, why are people so viscerally afraid? It comes down to a basic misunderstanding of what a market decline actually is.
People see their account drop by, say, 50%, and they think that money is just gone. Poof. Vanished forever.
But that only becomes real if you do one thing.
If you panic and sell.
Exactly. If you sell at the bottom, you book the loss. You make it permanent. But if you don't sell, it's just what the book calls a paper loss.
It's an unrealized fluctuation.
Yeah.
Like your house value dipping in a slow market.
Yeah.
You don't sell your house for a loss just because the appraisal is temporarily down.
Yeah.
You wait.
You wait for the neighborhood to recover. And the market recovery isn't just hope. It's practically a mathematical certainty over the long term, fueled by human progress and innovation.
I mean, if you just held on through the 2007 meltdown, you were back to even in less than 4 years. And the really great companies, the hero stocks, they recovered way faster than the index.
So the move is always to stay in. The book says to treat market declines not like a catastrophe, but like intervals of rain.
I like that. You don't abandon your road trip because it starts raining. You just slow down a bit and keep driving.
And if you have the cash, the real goal is to actually buy more when the companies you love are on sale. Trying to time the market, to sell at the top and buy at the bottom, it's a fool's errand.
You'll never get it right. You're always better off just staying the course. So that brings us to maybe the biggest excuse people use. I don't have enough money to start investing. And the author just demolishes this with his own story.
Oh, this is a powerful, just gut-wrenching story. He gets rejected from like 52 different newspapers. He moves to LA, a super expensive city, and he's covering homicide for $179 a week.
Not a lot to live on.
Not nearly enough. He eventually gets evicted, can't pay the rent.
And he ends up living in his car.
A Ford Fairmont.
A Ford Fairmont, yeah. He calls it a truly deplorable existence. And just to paint the picture of his mental state, he kept a .22 caliber pistol and a bottle of Jack Daniels right there with him.
Wow. So he's at rock bottom.
Absolute rock bottom. But even then, remembering the quiet example of Mr. Hank, he felt like he had to save something.
And he managed to mail $50 a month.
$50 a month. And he says sometimes it was a lot less to Fidelity. He put it in what would become Peter Lynch's famous Magellan Fund.
The lesson there is just, it's so much bigger than finance. It's about commitment. It is. If he could find a way to save those little dribs and drabs of money while living in his car, desperate, then nobody listening has a real excuse. It just completely dismantles the idea that you need some big lump sum to get started.
It makes you look at that extra $5 or $10 you spend every day on coffee or whatever, and you realize you're spending your future.
That small, consistent stream of savings is the path. Compounding does the rest.
So, okay, let's push back a little. What about safety? What about bonds or just holding cash, especially as you get older? Is the book really saying you should always be all in on stocks?
It's uncompromising on this point. The book's view is that the real gamble isn't being in the market, it's hiding from it.
Because cash doesn't grow.
Cash actively loses value. Inflation eats it alive every single year. And bonds, I mean, over the long haul, they basically just help you run in place. They might preserve your capital, but they're not creating real wealth.
By not owning stocks, you're actually risking economic catastrophe.
That's the phrase the author uses. You have persistent inflation, and you have people living longer than ever. You combine those two things, and hiding from the market's volatility is the guaranteed way to run out of money. Inaction is the biggest gamble of all.
Okay, so once we've conquered that fear and we're committed to investing, even small amounts, now the real work starts. How do we find those 5 hero stocks?
And the book's answer is just beautiful in its simplicity. The winners are hiding in plain sight.
They're not secret.
Not at all. They are the household names you already use every single day. And the best case study for this is the FNG acronym.
Facebook, Amazon, Netflix, and Google.
That acronym first started getting popular on TV back in February of 2013. And these weren't some tiny startups. They were already huge, well-established companies.
So let's look at the numbers, because this really drives the point home. If you put $1,000 in the S&P 500 index in early 2013,
A very sensible thing to do.
right, and you held it through the end of 2024, that $1,000 would have grown to about $5,000. A very respectable return.
Totally respectable. Average, but respectable. Now, compare that to the heroes you were probably already using every day.
That same $1,000 in Google now, Alphabet, would have grown to $10,000. Amazon, $16,000. Facebook, now Meta, $21,000.
And the big one.
And Netflix, the king of that group, would have turned that $1,000 into a staggering $36,000.
That is just, it's profound. The takeaway isn't that you needed some secret trading algorithm. You just needed to act on what you saw around you.
If Amazon boxes were piling up at your door, if you were binge-watching Netflix every night, if you were using Google for everything,
Yeah.
you already had the research. You knew who was winning.
So why don't people do it? It's inertia, it's fear. People see a stock has gone up and they think, I missed it. They get bogged down in the day-to-day news and they just retreat to the safety of the index fund.
The evidence was right there in their living room.
But the fear stopped them from acting. Which leads us to the author's ultimate example of this whole process, his discovery and investment in NVIDIA.
His greatest stock pick ever. And he's adamant it wasn't genius. It was just process and conviction.
Pure process, built over years. The first little spark came in September 2009. He was listening to a Best Buy conference call, of all things.
Not where you'd expect to find a huge stock tip.
Not at all. And someone made a comment about netbooks needing graphic processing units, GPUs. So he looks up the leader in that niche, and it's NVIDIA. At the time, he just knew them as a gaming chip company. That was breadcrumb number one.
And then conviction started to build when he met the CEO, Jensen Huang.
Yeah, in June 2010. And Huang, he looks more like a biker than a tech CEO with his leather jacket, and he was just relentlessly focused on one thing: fast chips.
So he had this obsessive leader.
An obsessive leader. But the real conviction came from seeing NVIDIA's chips pop up in places he didn't expect. They were in Audi cars, for instance, and the Audi CEO was praising their speed, directly comparing them to how sluggish Intel's chips were.
So he's connecting the dots.
He's connecting the dots. But the moment that sealed it, the real aha moment, was when he visited NVIDIA's headquarters. Jensen Huang basically showed him the future.
He showed him real-world applications.
Palpable innovations. He showed him an AI that could paint a beautiful Cezanne seascape in seconds, just to demonstrate the raw computational speed. He showed him robot dogs trying to learn how to pick up slippery Jell-O cubes.
And the black ice simulation, I love that detail.
The black ice simulation is incredible. They were running millions of simulations on their chip to design a car that would never slip on black ice.
Yeah.
And the author realized right then, NVIDIA isn't about gaming anymore.
No, it's making autonomous driving possible. It's making AI possible. It's foundational to the entire high-speed future.
That's the definition of a hero stock. But even with all that evidence, all that conviction built over years, the stock still stayed low for a while.
Which is where the conviction part really matters.
It's everything. And the final act was him trying to get everyone's attention by renaming his dog from Everest to NVIDIA in June of 2017.
And the numbers from that point are just crazy.
They are. The stock was under $4 then, split adjusted. If you had invested $1,000 the day he renamed the dog, recognizing that this was the moment process met conviction, that investment would be worth over $34,000 by the end of 2024.
That's the miracle. Process, observation, and conviction.
Exactly. Now, we have to contrast that with the other side of the coin, the spectacular but totally unstable world of meme stocks. GameStop is the cautionary tale.
This is a totally different game. It's a zero-sum emotional battle that has nothing to do with durable value.
Right. GameStop didn't explode because their business got better. I mean, it was a dying mall retailer selling physical video games. It exploded because of pure force of will.
From retail buyers organizing on platforms like Reddit's Our Wall Street Bet.
And they were specifically targeting companies that hedge funds were betting against or short selling.
So just a quick refresher on short selling.
Yeah, basically, big professional investors borrow shares, sell them, and hope the price drops so they can buy them back cheaper later and pocket the difference. Since GameStop's business was failing, it was a huge target for short sellers.
But the meme stock buyers, the memesters,
Yeah.
they didn't care about the business fundamentals.
Not one bit. Their motivation was emotional. It was to crush the hedge funds. So by coordinating these massive buying waves, they drove the price up violently.
Which forces the short sellers into what's called a short squeeze.
Right. The shorts are suddenly losing a ton of money, so they're forced to buy the stock back at these inflated prices just to cut their losses, which only drives the price even higher.
And at first it felt like this, insurgent revolution.
It did. But the author's point is critical. This is purely a zero-sum battle. You're only winning because someone on the other side is losing catastrophically. It's not investing. It's short-term speculation.
And the warning is that these squeezes always end. They're temporary. GameStop is an amazing stock story about a really lousy company.
That's the perfect way to put it. However, and this is important, that insurgent revolution is now a permanent part of the market.
So big money managers now have to pay attention to these groups.
They have to. They have to monitor communities like Wall Street bets, not to join in, but to understand what unpredictable emotional forces might be at play.
But the book's conclusion is firm.
The real, lasting generational money is made the NVIDIA way. It's not made in the short-term speculative battles.
Okay, so we're looking for these superior growth companies, but how do we actually evaluate them? The book starts by tackling the biggest mistake individual investors make.
Oh yeah, equating a low stock price with being cheap.
The story about his mom, Louise. She loved shopping at Giant Foods, which was trading at $24 a share.
And she thought it was a bargain compared to the competitor, ACME, which was $50 a share. To her, 24 is clearly cheaper than 50. Simple math.
But it's a huge error, because that share price, that number on the screen, is basically a meaningless abstraction on its own.
Totally meaningless, unless you know one other thing. The number of shares outstanding. This is the difference between price and the total value of the company, the market cap.
Let's use a simple example. Company A is $24 a share, but it has 10 million shares out there. Its total value is $240 million. Company B is $50 a share, but it only has 1 million shares. Its total value is only $50 million.
So in that case, the $50 stock is way cheaper than the $24 stock. You're buying a piece of a much smaller overall company. The price itself tells you nothing.
Right. So this gets us to the simple logic of what actually determines the stock price. The book breaks it down to a formula. Earnings multiplied by the market multiple.
Earnings, the E, that's pretty straightforward. It's how much profit the company makes. But the market multiple, the M, sometimes called the PE ratio, that's where the story is.
That's the market's collective judgment about the company's future.
Exactly. The market worships growth. And it assigns a higher M, a higher multiple, to fast-growing companies because it's willing to pay a premium today for the promise of much higher earnings in the future.
So a hot tech stock gets a high multiple because people think it's $2 in earnings today will be $5 in 3 years. A boring, stagnant company gets a low multiple.
And this brings us to the absolute mandate for any hero stock. It has to be built to scale.
Scale. The ability to go from small and regional to big and national or even global without your costs exploding proportionally.
This is a lesson the author learned the hard way from venture capitalists. He started an online news site, and he was proud that his goal was to be profitable at $25 million in sales.
And the VCs just laughed at him.
Laughed in his face. Their rule was simple. If you can't imagine a business hitting $1 billion in sales, it's not worth doing.
The goal is total category dominance.
Right.
For a young Amazon or a young Netflix, profit was secondary to getting that scale.
If you can't scale, you'll never get that massive multiple you need for hero stock returns. You might be a nice, profitable little business, but you'll never be a hero.
The book uses restaurants to illustrate this really well, the non-scalable versus the scalable.
Yeah, so the non-scalable example is a place like Bar San Miguel. It's this amazing, one-of-a-kind Mexican small plate restaurant. It's got an artistic chef, unique cocktails, a perfect vibe.
It's brilliant, but you can't copy it.
You can't clone it. The magic is in its uniqueness. If you tried to open 50 of them, it would fall apart. It's a great lifestyle business, not a growth investment.
Now contrast that with a highly scalable concept, like Texas Roadhouse.
Everything about Texas Roadhouse is a repeatable formula. The hot rolls, the honey cinnamon butter, the line dances. It's a system designed for replication, for scale.
Or a more modern example, CAVA, the Mediterranean chain. Their stated goal is to be the next Chipotle.
It's all about a streamlined process, a simple menu, and a repeatable customer experience. That's a concept built for $1 billion in sales. That's scale.
And for tech and software companies, the book gives us a really handy shortcut metric to judge this balance of growth and profitability. The Rule of 40.
The Rule of 40 is so simple and powerful. You take the company's revenue growth rate and you add its operating margin, and the total score should be over 40.
And a company can get there in different ways, right? High growth, lower margin.
Right, like a young company pouring all its cash into expansion. Or it could be lower growth, but really high margin, like a mature software giant. The balance is the key.
And the example of just extreme excellence here is Palantir.
Palantir's score in 2024 was an insane 68.2. That's just a company firing on all cylinders, growing fast, and being incredibly profitable at the same time.
So if you're looking for tech heroes, look for companies that crush that Rule of 40.
It's a great initial filter. And to finish that filtering process, the author gives us 3 types of stocks to just steer clear of no matter what.
Number 1, cyclicals.
Steel, copper, chemicals, lumber, their earnings are a total roller coaster. They're great in a boom, but in a downturn, they can get absolutely ruined. You want stocks that go one way up, not stocks that require perfect timing.
Number 2, financials.
Banks, insurance companies, they're just too sensitive to things you can't control. Interest rates, new regulations. And we've seen it time and again, they can just collapse overnight when the economy gets shaky.
And number 3, fleeting conceptuals.
These are the companies that lose money for years, have no clear path to ever making a profit, and are usually selling vaporware, some bogus idea that doesn't have a real lovable product behind it.
Unless they're like an early Amazon with a clear path to dominating a category.
Exactly. But otherwise, these are what he calls total pretenders. They just disintegrate when the market turns. You have to filter out the unpredictable and the non-durable to find your heroes.
Okay, so once we find a potential hero, a company that passes all these tests, the work isn't over. Now comes the homework.
And this is where things have just completely changed for the individual investor. The playing field is so much more level than it used to be.
The author talks about the old days, having to go to the library and use microfiche.
Oh, it sounds awful. Wrestling with those plastic sheets and a clunky reader, looking at SEC filings that were months out of date. It was a huge barrier.
That barrier is just gone. Now we have AI.
We have tools like Perplexity, ChatGPT, Gemini. You don't need to be a CPA anymore. You can ask the AI, hey, summarize the biggest risks from this company's latest filing and compare that to what the CFO said on the last 2 earnings calls.
And it does it in seconds. Work that used to take a team of analysts weeks.
But, and this is a big but, AI is a tool. It's not a replacement for doing the work. You still have to do your homework 4 times a year around earnings season.
And that diligence is your only defense against panicking.
It's your only psychological armor. When you know the company's micro story, when you know the business is solid, you can hold on when the stock drops for some external reason, like a presidential tariff or something. You know it's a buying opportunity.
So let's talk about what to look for in those reports. The book talks about clean beats.
Right. A beat is when a company does better than expected. But not all beats are created equal. A bad quality beat is one that comes from desperation.
Like a biotech company hitting its numbers by slashing its research budget.
Exactly. They're sacrificing their future just to look good today. Or a retailer that beats sales goals only because they had these massive margin-crushing sales. That's a sign of weakness.
But then there's such a thing as a good miss.
A good miss is so important to recognize. This is when a company misses its earnings target because it was investing heavily in future growth.
So, like, a chip maker misses because they spent a ton of money building 3 new factories to meet a huge surge in demand they see coming next year.
Yes. That miss is actually a signal of profound confidence. That's a dip you should be buying aggressively.
And beyond the income statement, the book really zeroes in on one metric as king.
Operating cash flow. It is arguably the most important number because it's the hardest for a company to fake.
So why is that?
Well, the bottom line profit, net income, can be influenced by all sorts of non-cash accounting tricks, like depreciation. But operating cash flow, or OCF, is just the pure cash the business generates from its normal operations.
It's the lifeblood.
It's the lifeblood. It's what you use to fund expansion, pay dividends, and survive a downturn. If your hero stock isn't consistently generating a growing pile of cash, it's not a durable hero.
And beyond the numbers, there's the nuance you only get from listening to the leaders on the earnings conference calls.
Oh, this is indispensable. This is where you get the context, the real story that an AI can't fully capture yet. You hear from the CEO, the CFO.
And it's often the CFO who moves the stock, right?
Yeah.
By giving the forecast for the future.
Very often. You think about Colette Kress at NVIDIA or Amy Hood at Microsoft. Their words on the forecast can send the stock soaring or sinking in an instant. You really shouldn't trust any move until the CFO has spoken.
And you can also get a great read on the whole economy by listening to the retail CEOs.
Absolutely. Doug McMillon at Walmart, Laura Alber at Williams-Sonoma, they give you a real-time pulse on what the consumer is doing, which is vital information.
The book uses Amazon's Q3 2023 call as a perfect case study for why listening matters.
It's a brilliant example. The CEO, Andy Jassy, he revealed this fundamental, massive shift in their entire U.S. logistics network.
They moved from one single national network to 8 distinct regional clusters.
Right, so instead of a package going from Texas to New York, it stays within its region. And Jassy's commentary was that this massive, complex change was going even better than they'd hoped.
So it meant faster delivery.
Fast delivery, yes, but more importantly, it meant massive, durable cost savings. The packages were handled less, traveled shorter distances. Fewer touches, as they say.
And that allows them to get into new, more profitable areas.
Exactly. Suddenly, they could efficiently deliver everyday essentials, the stuff you'd normally buy at the corner store. And the rumor was this change could drop their shipping costs by 40 cents a package. That one piece of commentary signaled a huge shift in their profitability, and it lit a fire under the stock.
Okay, so we've got the mindset, the observation skills, the homework process. Where should we be hunting for these heroes today? The book points to what it calls secular growth areas.
Right. These are trends that are driven by long-term, multi-decade shifts, not the ups and downs of the economic cycle.
And one of the biggest right now is next-gen power.
It's a huge one. The demand for electricity is just insatiable, driven by AI, data centers, all those high-speed chips we talked about. The grid is struggling to keep up.
So the opportunities are in the companies that can help solve that.
Exactly. For the bridge fuel, you look at natural gas. The U.S. has an abundance of it. So a well-run, low-cost producer like Coterra Energy is positioned for years of growth.
And on the hardware side, you've got a company like GE Vernova.
The GE spinout, yeah. They build and service the big natural gas turbines that power the current grid. But crucially, they're also a huge player in developing small-form nuclear reactors.
Which many people see as the only real long-term solution for powering all these data centers.
It's the only reliable zero-carbon source that can handle that kind of load. So even if it's years away, investing in the infrastructure builders today is a multi-decade play.
Another gigantic secular trend is blockbuster drugs, specifically Eli Lilly and the GLP-1 drugs.
Ozempic and its clones. And the book argues the market is still massively underestimating how big this is going to be.
It started with diabetes and weight loss, which are already huge markets.
But the potential applications are just exploding. It's already approved for heart disease, sleep apnea.
And the pipeline includes things like liver disease, alcoholism, even Alzheimer's.
We are talking about a class of drugs that could fundamentally transform human health and longevity across the board. The market for that is just astronomical. It makes Eli Lilly a very strong candidate to join the trillionaire club.
The book also points to winning business models, like the subscription model.
It's so sticky. Amazon Prime is the best example, with over 220 million subscribers, providing that predictable, high-margin revenue.
But the ultimate retail hero mentioned is Costco.
Costco is a masterclass.
Huh.
The reason it's worth its high price tag, often over 50 times earnings, is because of its focus on volume, its incredibly high employee retention, and that treasure hunt experience.
And the genius is they make almost all their profit from the membership fees.
Right, which lets them sell goods like that famous $1.50 hot dog at ridiculously low prices.
Yeah.
That builds insane loyalty. It's a durable defensive formula for any market.
So what about the original heroes, the Magnificent Seven? Can they still be hero stocks?
Well, they definitely face some new challenges. Apple's got issues in China, potential tariffs. Alphabet's Gemini AI could end up cannibalizing its own super profitable search business.
But they're just too fantastic to ignore.
You can't ignore them. They have fortress balance sheets, tons of cash, proven leadership. The advice is pretty practical. If you picked 3 of the strongest of the Mag 7 for your 5 hero slots, that's still a very sound strategy.
But things go wrong. You're not always going to be right. So the book gives two absolute rules for when to sell.
Rule number 1, sell immediately if you see mounting lawsuits or existential threats. This is when the trial lawyers start circling, suing over a major scandal or a flawed product. That's a risk analysts can't really quantify. You have to get out.
And rule number 2, respect the tonent of selling.
This is critical. If a stock opens down, say, 50% after an earnings report, you have to accept that the big institutions are dumping it for a reason. They know something you don't.
Don't double down. Don't try to be a hero and catch the falling knife.
Never. That wasn't just panic, it was smart money getting out. You just have to cut your loss and move on. Find the next hero.
Which brings us all the way back to the beginning, the final, necessary conclusion. Why do this? Why is this a necessity, not an option?
Look, the author is just. He's done with the excuses, done with people saying they'll never have enough. The greatest wealth transfer in history is happening right now, from the boomers to the next generation, and the only way to guarantee you fail is to sit on the sidelines.
Yeah, it comes back to his own story.
It does. If he could save those first tiny bits of money while living in that deplorable existence in his Ford Fairmont with a gun and a bottle of Jack Daniels and turn that commitment into millions, then everyone listening today has the chance to start.
So the final thought is really a challenge.
It's an immediate choice. Are you going to commit to the process, do the homework, and find your own future Microsoft or Amazon? Or are you going to give up on saving, which is really just giving up on yourself? His final line just rings so true. You have the power to decide. I am not going to tolerate this damned poverty anymore.
Thanks for listening. And remember, this is Core Concept HQ, where we break down powerful ideas to help you live smarter. See you in the next summary.